The person we are examining today is not a trader drawing lines on a screen in the classical sense. The person we are going to talk about today is someone who approaches the market from the perspective of physics, statistics, machine learning, and systematic thinking, Ernest or Ernie Chan. What makes Ernie Chan important is not just that he has written books in the field of quantitative trading. What truly makes him important is that he looks at financial markets from the outside, like a scientist, then sees that the real market is much harsher than academic models, and ultimately transforms his own approach into something simpler, more testable, and more disciplined. Chan's story contains a very valuable lesson for the modern trader, because his journey shows us that to be successful in the market, building the most complex model, getting the most beautiful backtest, or just knowing machine learning is not enough. If the data is flawed, if the strategy is over-optimized, if transaction costs are not taken into account, and if the model is not tested in the live market, a system that looks perfect on paper will collapse in the real market. Ernie Chan's career begins with a background in physics. After getting his PhD in theoretical physics at Cornell University, he worked on machine learning and artificial intelligence at the IBM T.J. Watson Research Center. His work during that period coincided with the early days of today's natural language processing technologies. He worked on topics such as teaching computers to understand human language, speech recognition, machine translation, and building statistical models over big data. The important point here is that when Chan first entered the market, he was already someone who knew how to think with data. For him, the market is not just a chart consisting of candlesticks. It is an area where data, probability, noise, false signals, and statistical significance intertwine. After IBM, his path led to Wall Street. He worked in Morgan Stanley's data mining and AI group, and later he took part in proprietary trading teams at Credit Suisse. But here he faced a very important reality. Machine learning models look very good in backtesting, but do not yield the expected results in the live market. This is exactly where Chan's revolution in his approach to technical analysis and the market begins. He is not someone who completely rejects technical analysis. On the contrary, he takes technical analysis out of being a visual charting art and treats it as a market behavior that must be statistically verified. For instance, a classical trader might look at the price and say, the price has moved away from the average, it might revert. Chan, however, puts this into a completely measurable framework and asks the following questions. How many times has this divergence happened in the past? Does mean reversion really exist? Is it still profitable when transaction costs are added? Does this condition work in different periods? Does the data contain survivorship bias? Could the signal have produced a look-ahead bias? This difference is crucial, because in Chan's world, the value of a technical signal comes not from looking good on a chart, but from surviving after a realistic backtest, clean data, transaction costs, and live market performance. In his presentations on machine learning and quantitative models, there is a very clear emphasis. Technical indicators are not signals, they are features, meaning model inputs derived from prices. However, these inputs must be high quality, stationary, synchronous, and error-free. Lagged values, technical indicators, signal processing methods, and time series coefficients can be transformed into models. Translated into our technical analysis language, this means RSI alone is not holy, Bollinger Bands alone are not holy, moving averages alone are not holy. However, if used in the right context, with the right data, and with the right testing, they can be part of a powerful model. Therefore, Chan's goal is not to look for a single magical indicator, but to make repeating behaviors in the market measurable. Financial data is very different from classical machine learning problems. You can use millions of articles to model human language, but if you are working with daily financial data, you often have a limited number of samples. Moreover, these samples are not clean. Regimes change, liquidity changes, spreads change. A signal that worked yesterday gets crowded today and loses its edge. Realizing this reality, Chan moved away from complex machine learning models and turned to simpler, traditional quantitative models that use fewer variables. Even though he is capable of building complex models, he doesn't seek success in complexity, because market data is noisy, and as parameters increase, the model memorizes the noise of past data instead of learning the market. We can call this data snooping bias. A trader tries hundreds of combinations, finds one that worked perfectly in the past, and thinks it is a real edge, whereas what they have found is not a signal but a coincidence specific to the past. Simple strategies, on the other hand, can be tested, understood, and their errors can be caught much more quickly in the live market. Few variables, solid logic, realistic testing, and validation with small capital in the live market are at the core of his philosophy. Backtest using Chan is extremely skeptical. While many traders think backtest results are real, Chan sees them merely as a hypothesis test. If the backtest is bad, the strategy is eliminated, but if it is good, it only means it is worth researching, not that it will definitely work in the live market. Instead of assuming the system is real, he questions the accuracy of the data, transaction costs, the spread, and whether the model is over-optimized. Because things change in the live market. The price you send the order at might not be the executed price. He is obsessed with transaction costs. Even if the signal is correct, the spread, commission, slippage, and market impact in large orders can kill the system. He explains how even a 1 basis point transaction cost can turn a perfectly looking Sharpe ratio negative. According to Chan, a bad strategy doesn't always look bad. Sometimes a bad strategy looks like a good backtest with no transaction costs added. Survivorship bias, or survival illusion, is another major danger he frequently warns against. Testing the past only with companies that are still alive today makes historical performance look much better than it actually was, because bankrupt and failed companies have been wiped out of the dataset. This situation is especially dangerous for mean reversion strategies. The mean reversion model buys what drops and sells what rises too much. But if the falling company is actually going bankrupt, what the model calls cheap might actually be the very beginning of extinction. At this point, Chan's distinction between mean reversion and momentum is a critical issue in terms of technical analysis. On the mean reversion side, the tendency of the price to return to the average after moving too far away is sought. Structures like Z-score and pair trading belong here. On the momentum side, the expectation is that after the price moves in one direction, it will continue in the same direction, which is usually formed by the slow diffusion of new information or herd behavior. The psychology and profit distribution of the two approaches are entirely different. While mean reversion strategies generally see a large number of small wins and rarely a large loss, momentum strategies see a large number of small losses but rarely large wins that carry the whole system. You cannot manage a strategy without knowing its psychology. A trader doing mean reversion feels safe because they win frequently, but the real risk lies in that rare big loss. The momentum trader, on the other hand, is constantly exhausted by losses, but their real value lies in catching those few big moves. According to Chan, the main issue in technical analysis is not the name of the signal, but the profit distribution of the signal. Building models according to the market's microstructure is also his area of expertise. He rejects the logic that the same indicator works on every chart. Knowing that gold, oil, or indices do not behave in the same way on the futures side, he builds separate models specific to each instrument. In equities, instead of individual stock selection, he mostly uses market-neutral long-short models. He doesn't fall in love with a single strategy. He runs multiple strategies together, because every model has a market environment where it is weak. While one suffers from volatility, another might be exposed to beta risk. Good portfolio management is not about finding a single flawless system, but combining different risks to balance each other out. He is extremely cautious even when allocating capital to a new model. Live performance is monitored. If the model works, capital is increased over time. If it weakens, it is phased out. In other words, even if quantitative trading is fully automatic, it constantly requires common sense and discipline on the capital management side. His strategy development process is also quite pragmatic. He uses academic papers, books, or blogs as sources of ideas, but he never views any of them as a prescription. Publicly available ideas are merely sources of inspiration. Copying a strategy exactly doesn't work because transaction costs are different, data quality varies, or the strategy has already become crowded in the market. A good trader is someone who takes that idea and retests it on their own dataset, within their own risk logic and execution conditions, adding risk filters and costs to it. When it comes to machine learning, his approach does not contain blind admiration. Despite his IBM and Morgan Stanley background, he does not view AI as a magic model that solves everything. He draws attention to the risk of over-optimization, the intense need for data, and the challenging feature engineering. Instead of using machine learning like a black box, he positions it as a risk filter, a trade acceptance or rejection layer, or a tool that generates probability for capital allocation. The model doesn't just say buy or sell, it adjusts position sizing based on the probability value of this signal. Meaning, if used correctly, ML is not something that replaces technical analysis, but a smart layer that makes it more systematic. In conclusion, Ernie Chan is not someone who rejects technical analysis, but someone who disciplines it. For him, price action, volatility, momentum, and indicators are valuable. but only as long as they are measured, tested, punished with transaction costs, and verified in the live market. What makes him successful is not finding a secret formula, but knowing very well the mistakes everyone else makes in the market, namely, believing too much in backtests, assuming data is clean, underestimating transaction costs, and thinking complex models are smart. He takes technical analysis away from being an art of prediction and transforms it into testable and manageable systems engineering. To survive in the market, there is no need for more showing off, but for discipline. Not for more complex models, but for solid tests and good risk management. A real quantitative trader is not just someone who writes code, but someone who knows where the data can lie. The biggest lesson Chan teaches is exactly this. Before a winning model in the market comes the right way of thinking.